Right now is Mr. Seth Freeman, the Senior Managing Director at GlassRatner Advisory and Capital Group. Seth, thanks so much for joining in on ET Now. A massive decline in equity prices globally. What would you attribute this correction? It sort of kick-started from the United States, but would interest rates and the fear of a higher interest rate policy, tighter monetary policy in the United States and in a lot of developed markets be a key reason for this fear? Because mind you, the sell-off is not just in emerging markets, but like I just flagged off, even in the US and Europe.
Right. Well, we have a lot of economic news coming together all at once. In particular, high oil prices. And it looks like sustained high oil prices, particularly in light of concern about sanctions against Iran. That's number one. And then some expectations of continuing inflation in the United States. And as we look back just a couple weeks, we were talking about the yield curves being very flat, and in a relatively short time, 10-year treasuries rose quite a bit. So that, and frankly, I think there's some concern about the inflationary impact specifically from tariffs and the so-called trade war.
Okay, you spoke about inflationary impact, Seth, and naturally that is something that is going to lead to, Jerome Powell and his team to essentially make sure that a tighter monetary policy does remain, or at least, 2-3 more hikes at least are on the annual for the next, for the next half or the next 1 year. In such a scenario, do you believe that EMs, particularly India, are at a risk of outflows? Because, we did have the IMF chief as well speak exclusively to ET Now, saying that outflows are not happening yet, but it is a very material risk. So how much of a risk do you think EMs are at, particularly when it comes to a flight of capital on account of tighter monetary policy?
Well, I don't think we're going to see the so-called flight of capital that we had, 10 years ago, when the market was so sentiment driven and investors, foreign investors in particular, would just yank out money and cause a tremendous amount of market volatility and market instability. One of the big buffers for this is the fact that there's so much index-based investing now. And a lot of that, there's institutional investment. There's quite a bit of quasi-institutional and retail investment in emerging markets, and that money is going to be a lot stickier. On the other hand, India is now, less attractive in the near term because of higher interest rates in the U.S. and certainly higher expected growth rates, relative to how robust India has been the last 20 years and certainly the last 5 years in general. So those are reasons why I think we're going to see redemptions. I don't think we're going to see a tidal wave of outflow from India like we've seen before, but it doesn't take a whole lot to have impact on the Indian market. The positive news, though, is over the last 3 years, we've seen such great domestic participation in the equities markets, and that's really helped a lot. But look at the decline in FII or FPI participation in the debt market. I was looking at some stats the other day. The number of FPI registrations has declined significantly. So there's certainly a less excitement today by foreign investors.
Right, as you said, definitely, Seth, it has been the domestic flows which have kept our markets afloat to a certain extent, while the sustained outflow by the foreign institutional investors has really left everyone quite perturbed. The other big factor is the currency. The dollar has remained quite steady against a basket of other currencies, particularly emerging market currencies like the rupee, which is yet again seeing a free fall. What exactly is your assessment as to where the currency is headed, given that it is a fairly difficult global as well as domestic environment right now?
I think we're going to see continuing pressure against the rupee. It wouldn't surprise me if it lasts as long as the next 6 months, just because of relative interest rates and some of the factors we've discussed already. And what really hurts India quite a bit is higher oil prices. I say this too often, oil's priced in dollars. And so and India is such a big net importer of oil. This really puts extra strain on the rupee.
So what's the final assessment, Seth? What do you think, investors should do at a time like this? We just heard out some other global market experts saying that once we see a little more stability in the US markets, until then, investors should just sit tight. Should that really be the approach as of now?
Well, as you know, I've had a very strong long-term view on India. And so for some investors, you're probably better off not even looking at this. And if you have a long-term view, possibly take advantage of any kinds of extreme price declines in good Indian companies. I love to go back to a Wall Street Journal article I kept from 2004, December in 2004. The Sensex had hit around 6,800. And the headline was, Indian market reaches a new high. It's time for investors to take a breather. So that was 6,800 about 14 years ago. Now, the rupee has declined in half, but that's still not a bad return over 14 years. And the Indian economy is still going to keep growing at a high rate for decades. But in the meantime, investors get nervous.
Yes, they sure do. At a time like this, everyone seems to be hitting the panic button. But your view is definitely taken into cognizance, the fact that you're saying, this is a good time to invest in some quality companies. Seth, appreciate you taking the time out and joining in with your assessment of what's going on globally, back home, as well as the FI flows. The markets continue.